Welcome to the deep dive. Today, we're unpacking something quite surprising in global finance, really. It's the resilience of the European housing market.
hmm
When central banks started hiking rates so aggressively, I mean, the sharpest cycle since the early 90s, everyone pretty much expected property values to just crater.
Thinking back to the GFC, right?
That was absolutely the consensus view. You had runaway inflation, rates shooting up, and let's face it, many markets looked overvalued already.
All the ingredients were there.
Exactly, the perfect storm, seemingly for a major bust. But instead, well, the official reports from the ECB, the European Mortgage Federation, Fitch, they're all calling it a mild adjustment.
Five.
Mild. So our mission today is really to dig into these sources and figure out why the system bent but didn't actually break, what protected it, and importantly, where might the next risks be coming from? Things like environmental policy, for instance.
Yeah, that tension is fascinating. Overvaluation meets this huge rate shock, but the market holds up much better than expected. And the proof is, well, kind of stunning, actually.
Yeah.
Right.
Latest data suggests that by Q3 2024, the average euro area house price was already back above its 2022 peak. How is that even possible if the crisis was just sort of postponed?
That's the puzzle, isn't it?
Yeah.
And the answer, according to these sources, boils down to systemic reform. They're pretty unanimous on this.
Okay.
The main reason for this resilience is that both households and banks had fundamentally stronger balance sheets this time around compared to, say, the GFC or the sovereign debt crisis.
Ah, okay. So policymakers had quietly been building defenses, is that it, during the good times? But how, specifically, were those macroprudential policies we heard about the real key?
They were absolutely crucial. You saw lower mortgage credit growth relative to GDP in the years leading up to this, and importantly, lower debt service ratios for households.
Right.
And yes, that was largely thanks to those macroprudential tools the rules put in place across Europe after the last big crisis. They effectively limited the amount of really risky lending that banks could do.
Okay, just so everyone's clear, when we say macroprudential, we're talking things like loan-to-value caps, LTVs, and debt service to income limits, the DSTIs. Can you quickly recap what they do?
Sure. So LTV limits cap how much you can borrow relative to the house price, meaning you need a bigger down payment.
Got it.
And DSTI limits cap the percentage of your monthly income that can go towards paying off debts. By making these rules stricter, regulators stopped banks from issuing huge mortgages to people who might struggle to repay, especially if rates went up.
So less leverage in the system overall.
Exactly. That prudence during the boom years meant fewer potential defaults when the rate shock finally hit. It created stability.
And that structural strength was helped by something else in many countries, the type of mortgage product itself. Fixed rates, right?
Absolutely. That shift towards fixed-rate mortgages in places like France, Belgium, the Netherlands, that was a huge, if temporary, shield.
Oh, so?
Well, when the ECB jacked up rates, homeowners with fixed-rate deals saw no change in their monthly payments.
Yeah.
That kept defaults low, kept people in their homes, and just generally stabilized the market.
But let's be honest here, that fixed rate shield is temporary, isn't it? For millions, the pain hasn't gone away, it's just delayed until their deal expires. Isn't that a bit of a ticking time bomb? Especially if wages don't keep up.
That is the big counterpoint, yes. And the sources acknowledge this risk. When those fixed deals end and reset to today's much higher rates, payments will jump significantly.
Right.
That risk is definitely concentrated in the next few years. Although the ECB does note that because rates went up so fast, some of the earlier fixed-rate deals are already resetting. But yes, the bulk of the mortgage stock is still protected for now. It's a deferred risk, absolutely something to watch closely, but maybe not an immediate cliff edge.
Okay, deferred risk. Let's talk about the immediate shock, though, for new borrowers in 2023. The numbers are quite something. The average mortgage rate across the EU 27 shot up to 4.72% last year. That's up from just 3.11% the year before.
And it peaked even higher, didn't it? In the third quarter of 2023, the average hit 4.95%.
Wow.
That's the highest we've seen since they started collecting this EU-wide data back in Q1 2009. And the market reaction was swift, just as central banks wanted. Gross lending for homes in the EU dropped massively, down 26.6% year-on-year.
A huge drop in demand.
A significant chilling effect, yes.
But again, that huge drop in new loans didn't lead to a uniform price collapse everywhere, which brings us back to those differences in mortgage structures across countries.
Precisely. That diversity really dictated who felt the pain first and how badly. You look at the extremes. France issues almost all new loans, like 99% on fixed rates.
Okay.
So their market felt the pinch through tighter lending standards and lower volumes. but existing borrowers were okay for the moment. Now contrast that with markets heavy on variable rates, Bulgaria, Finland, Norway.
Ah, they felt it immediately.
Instantly, borrowers saw their monthly payments soar, which likely forced more sales and led to faster price corrections.
So resilience wasn't one single policy. It was this mix of national buffers and mortgage types.
That's right. Those macroprudential tools we talked about earlier, the LTV and DSTI limits, they were already in place in countries like France, Estonia, Slovenia. They'd limited the risk-taking before the shock, so even though the rate hike was global, the consequences were uneven and, crucially, manageable at a national level.
Which means looking at the EU average price change is really misleading. If we dig into 2023, you see this wild regional roller coaster. Who are the big winners and losers?
Oh, the divergence was huge. The biggest price falls were generally where prices had run up a lot before and where markets were sensitive to rates. Think Luxembourg, down a hefty 14.4%. Germany dropped 7.1%. Finland was down 4.4%.
Ouch!
But then you flip it and you see strong domestic demand pushing prices up sharply in parts of Eastern and Southern Europe. Poland saw prices jump 13%, Bulgaria up 10.1%, Croatia up 9.5%. Massive swings.
Let's dive into those downswings a bit more. Germany and Sweden, why did they get hit so hard?
Well, both were wrestling with, frankly, significant prior overvaluation and a high reliance on construction. In Germany, the number of actual sales, existing homes changing hands, fell by almost a quarter.
24%.
Yeah. Affordability just hit a wall for buyers. And Sweden, which is mostly variable rate, saw house prices fall almost 10% in 2023. But what's maybe more worrying for Sweden long-term is that housing starts, new construction projects just collapsed, down 53%.
53%? Wow.
Developers just couldn't make the numbers work with those interest rates. That suggests a serious supply crunch coming down the line, even if demand recovers.
That sounds like intense pressure. Now, contrast that with a market that seems to have completely defied gravity, the Netherlands.
The Netherlands. Yes, it's a fascinating case. Despite the rate hikes, they had these unique protective factors. Very strong wage growth, for one, which helped cushion the blow for households.
Okay.
But the absolute killer factor there is a chronic, persistent housing supply shortage. Local planning, land release, it's just incredibly tight.
So not enough houses being built.
Fundamentally. And because of that tight supply, Fitch actually revised its 2024 price forecast for the Netherlands upwards to 8–10% growth. And by April 2024, Dutch prices were already past their 2022 peak. It shows that if supply is tight enough, financing costs almost become secondary.
Incredible. And looking east to Poland with those huge gains, is that a similar story of strong domestic demand just overriding the rate hike?
Pretty much, yes. Even now, early 2025 data shows nominal price growth slowing a bit, but real prices compared to wages are still rising.
Still going up relative to income.
Still going up, which points to a serious ongoing affordability issue, especially when you factor into very high rent increases in cities like Warsaw. It seems strong employment, population shifts, just basic domestic demand kept the market powering through, despite borrowing costs. It really underlines how localized these effects can be.
Okay, so the rate shock seems, broadly speaking, managed, maybe deferred in places. But you mentioned another element earlier that sounds potentially disruptive: the future value and usability of properties themselves. Let's pivot to that, the green mortgage revolution. Sustainability is becoming core to housing finance, isn't it?
It really is. It's moving fast from just an idea to actual strategy. We're seeing this through things like the Energy Efficient Mortgages Initiative, the EMI. Essentially, a green mortgage offers better terms, maybe a lower rate, if you buy or renovate a highly energy-efficient home.
And is this catching on?
The numbers suggest it is. Look at Italy. Green mortgages were 12% of new home purchase loans in 2023, up from 9% just 2 years before. Romania reported almost 29% of new housing loans were green in late 2023. So yeah, it's moving into the mainstream quite quickly.
But there's a stick as well as a carrot here, isn't there? Particularly regulations targeting inefficient properties, especially in the rental market. That sounds like it could create real problems for some owners.
It absolutely could. France is probably the key example here. They've set a hard deadline schedule based on a property's energy performance certificate, its EPC rating.
Okay.
Starting January 2025, the worst-rated properties, G-rated, can't be rented out anymore. Then F-rated follow in 2028, E-rated in 2034. If you own an old, inefficient rental property, you basically have to spend potentially huge sums on renovations, or else you can't rent it out. which obviously hammers its value.
That's a massive potential cost transfer onto owners. It must fundamentally change how those properties are valued and the risk associated with lending against them.
It has to, yes. And what's interesting is that research is already showing a clear link between those EPC ratings and actual credit risk.
Really? How so?
Studies show that loans for the most energy-efficient homes tend to perform best fewer defaults.
Hmm.
The market is starting to price in this risk of, you could call it structural obsolescence for inefficient buildings.
And according to the sources, there's a particular group that's most vulnerable to this emerging risk.
That's the crucial and perhaps worrying insight. This link between energy efficiency and loan performance. It's strongest for the lowest income households.
Ah.
Within any income group, mortgages on efficient homes do better. But if you're a lower income homeowner, or maybe a small landlord, and you own an old, inefficient G-rated property, the cost of mandatory renovations or the hit to the property's value if you can't renovate is a much bigger burden relative to your means.
So the green policy, while needed for climate goals, potentially creates this concentrated credit risk that hits the least financially flexible people hardest.
That seems to be the emerging picture, yes. A new kind of risk profile.
That connection environment, property value, financial risks, especially for certain groups, feels like the perfect place to wrap things up.
Okay, so to summarize, the European housing market showed surprising strength facing that huge rate shock. We avoided a major crash, largely thanks to stronger bank and household finances, the shield effect of fixed-rate mortgages in some key countries, and those macroprudential limits put in place earlier.
Right. Structure matters.
Structure and past reforms really paid off. It was more of a managed adjustment than a meltdown.
So we navigated the interest rate shock, proving the value of that earlier prudence. But the story isn't over. Those fixed-rate resets are still coming down the track for many homeowners. And now this green transition adds a whole new layer of complexity. Given that energy efficiency is now directly linked to property risk, to credit performance, and it seems to bite hardest at the lower end of the income scale. Well, it leaves us with a big question for you, the listener, to think about.
Yeah.
As policymakers rightly push for a sustainable housing stock, could this inadvertently create a new kind of affordability crisis? Could it concentrate financial risk in unexpected ways over the next decade, even if the system proved resilient to the last shock? That feels like the next big challenge brewing.